Hello, fellow investors. Welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Nidhi Jamdar, and Nidhi is the co-founder of Open Spaces Capital and the co-author of a new book called Accelerate Your Real Estate, which is published by Bigger Pockets. So, Nidhi, really excited to have you on the show today.
Thank you so much for having me, Ken. I'm excited.
Yeah, so let's learn a little bit more about you and your career and how you've got into real estate. Start off by telling us a little bit about who you are and how you got to be where you are today.
Sure. So just a quick backstory going way back. So my wife and I, Palak and I, we're business partners, and we are first generation immigrants. We came here for our masters, and then we followed the very traditional path that society tells you, right? You get a degree, you get a job in a good company, and then you just climb the corporate ladder. And we did that for, I want to say, like almost 15 years, and then we had kids. And we realized that we need more time in life other than just our corporate lives to be able to spend time with our family. And working in corporate for 15 years didn't really give us the financial freedom that we'd hoped or even put us in a good position. And so we had to almost rethink everything. And so when our daughter, who's older, she was 2, and our younger son, who was about 2 months old at the time, we were like, something needs to change. And that's when we found real estate. We were always loved real estate and watching all these shows on TV. And we figured, why not do a side hustle and maybe get a couple of properties and see how it goes. And that's how we got started in real estate. And in a few years, we were able to both, transition full-time into real estate, quit our corporate careers that we had worked very hard to build and that we actually liked, but it wasn't giving us what we needed, which is time freedom, financial freedom.
Gotcha. I love that story. I mean, that story rings so true with many of us. I mean, my story is very similar. You're pursuing the corporate career, you have kids, it sends you in a different direction. And real estate was a way to balance both time, freedom, and money, right?
Yes.
So we continuously hear that story, but I love another rendition of it. It doesn't get old. And so
Yep.
as you think about where you've come and leaving your corporate career and investing in real estate, I mean, talk a little bit about where you started to where you are now, right? And talk about a little bit about your strategy and what your focus is.
Sure. So when we first got started in real estate, we bought like a couple of rent-ready rentals close to where we lived, right? These are just like a small single-family home. We bought it rent-ready and we rented it out. And we did a couple of those. And it worked really well because, we were getting cash flow every month. And in a year or two, the properties had appreciated quite a bit. And we're like, wait, we need to do this, except that there was a big capital constraint where every time we had to buy a property, we were like, we have to bring $60,000-$70,000 to the table to put 25% down plus closing costs. And we thought there has to be a better and faster way to do this.
Mm-hmm.
And that's when we kind of discovered the BRRRR strategy that people call. So for those of you who are not familiar with it, it's basically you buy that property, you rehab it to increase the value and force the appreciation in the short period of time. And then instead of selling it like most flippers do, we actually keep it and we rent it out and we refinance, pull the cash out from it that we'd put in the initial investment, and then we just reuse that same capital for the next deal. And that was game changing for us. Like we used that strategy and we were able to scale to a $10 million portfolio in about 4.5 years. And that was really what propelled us, because we could reuse the capital. The velocity of money really helps, right? Because instead of doing one deal a year, we were doing 5 to 10 deals a year in year 2, year 3. And so I think that really changed everything for us.
Yeah, I think that velocity of money is so important when you start to really get that snowball effect, right? And it really builds and builds and builds as you start to sell and buy, double down, delay taxes, roll it forward, right? There's a ton of power there to really build wealth. And I think that's one of those little secrets that is tough to understand until you're really in it. But when you hit that, as you said, similar experience, that 2 to 3, maybe 4 years in, and really, wow, yeah, this is really working. And looking at this happening,
Yes.
We're starting to sell and buy and just roll it forward, really build that snowball as it accelerates downhill, right?
Totally.
Well, really cool. I love that. Love the entrepreneur mentality and just the ability to go out, take a leap and leave, what sounds like successful careers, but really chasing what matters most, time with family, freedom, and really more security by creating your own income stream versus relying on your W-2, right? I think that's one of the myths that really catches people is the security of your job. It's very secure. You get a paycheck every 2 weeks until you don't, right? And
Yeah.
so then what's plan B? And I mean, that's one thing I'm always preaching to people is it's all about multiple streams of income. It's never
Yes.
putting all your eggs in one basket, never relying on somebody else for your income. It's great to have a W-2, but you need to have that as one source of income, and you need to build others. And then ultimately what ends up happening to a lot of people like yourself, right, is the others start to take over.
Yes.
You start to realize a W-2 doesn't make that much sense anymore. So fantastic
Absolutely.
story. I mean, I think you're a great just case study in how this can really work.
Yeah.
But really cool. So it's all gone really well, right? And then, now we're in 2023. I think the world feels a little different now, right? There's a little more uncertainty. Interest rates are high. Inflation is maybe high, maybe not, depending on who you talk to and which person you listen to. So there's just this uncertainty out there. And so in today's market, I mean, give us your perspective on investing today. And has that perspective changed from what you were doing previously, or is it the same? But just give us kind of a pulse of where you guys are now.
Yeah. Great question. And this is a question that comes up all the time. And in fact, this question has been coming up since we first started investing back in 2014, 2015. And everybody was asking at that time, like, is it a good time to invest? Because it had been a few years since the great, recession of 2008. And it had been 6 or 7 years. And people are like, oh, that's the cycle. Now we're going to see a recession.
Mm-hmm.
And a lot of people, even back then, were staying on the sidelines thinking that something is coming, and it never did, right? And so the way I think about it as a full-time investor is the right question to be asking in any market cycle is not, is this a good time to invest? But how should I be investing right now in this market, right? That is a much better question. And, just going back to even 2014, 2015, at any market cycle has its challenges and its advantages, right? And you as an investor have to figure out what the challenges are for that market cycle and solve for that. So when we started investing 2014, 2015, and we started the BRRRR, process, we realized that deals were easier to come by back then because it wasn't as competitive. It was easy to find contractors. That was fine. But it was very hard to obtain financing. There weren't that many lenders, especially what we call like hard money lenders and short-term lenders back then. And so Palak, my wife, she had to call 100 banks to find one lender for one project, right? And that was, we had to put in that work because that was the biggest challenge at that point in time. And then, fast forward to when the pandemic hit, things changed a little bit, right? There was suddenly supply chain constraints and materials got expensive, and there was all this competition because of all the money being printed by the Fed. There was just so much money in the market, so many new investors vying for the same deals, and interest rates at an all-time low at that point. It was very, very competitive. So at that point, you had to solve for, you're bidding, for every property that you wanted to buy, there was at least 2 or 3 or more cash offers. And the challenge then was, how do I get more competitive with my offers? How do I increase the velocity of the time that I take from the time that I see a property to putting in an offer? And how do I improve my systems and processes to be able to do that faster? So that was a big challenge then. And then, now 2023, things have changed again. Now supply chain constraints have eased up a bit. So material prices have stabilized. It's a little bit easier to find contractors today than it was even a couple of years back. But now the challenge is just higher interest rates. And again, there is a solution for that, right? Just like with anything else, you just have to try hard to find it. And so now it's just a question of you're still analyzing deals the way you normally would. And if hopefully you have a good deal analyzer that you're using to analyze your deals, and knowing how to analyze the deals becomes super important, right? Are you calculating your numbers correctly? Are you calculating your ARV and your rents, and are your assumptions good? And then once they are, then the interest rate just becomes a part of that equation. And what other levers do you need to pull in that equation to be able to make the numbers work? So we are absolutely buying, continuing to buy properties, because the question is not, is a deal going to work because of high interest rates? The question is, what else you need to change to make the numbers work? Can I buy it for a little bit cheaper, which you can now because it's not as competitive in most markets. So I think, so sorry for the long-winded answer, but I think to summarize, it's
Yeah.
never the perfect time to buy. We're in the long-term buy and hold game. And when you're in the long-term buy and hold game, it's things like market forces become less of a factor, because in the next 2 or 3 years, say there's a recession, that's fine, but my cash flow is still going to get me through that. And over the next 10 or 15 years, property prices and rents are only going up.
Yeah. Yeah. Well, no, I think that was a great answer, multifaceted, but I like to just break it down in that what you first said was it's not about if you should be investing or even when, it's how, right? And I love how you said each phase of a market cycle has its own benefits and its own challenges, right? And it's about understanding those, and it's about adapting and solving for those challenges. And I think the interest rate example you gave is a great example. It's not that no deals work because the interest rate is X, but it's about understanding if the interest rate is what it is, what else has to change, right? Or it's about understanding whether you believe we're going into a recession or not. Real estate has shown that it holds up well over time. Over time, values have always gone up. And if we remain mindful that the average recession is about 9 to 11 months, then you just have to make sure, as you said, it's cash flow focused investments, which, you and I are both on the same page there. That's our focus as well. You want to be able to produce a decent cash flow. And in a recession, what do? You hold on, you cash flow, and you wait till market conditions improve. But it's the people that invest through uncertainty with courage and capital that are again and again shown to get outsized returns, right? I mean, there's a million examples out there. There's even studies out there by economists that showed people that have invested in those down times, whether you go back to kind of after .com, or you go to the great financial crisis, or you go to COVID. I mean, the people that invested in 2009 and 10, the run up since then has been incredible, but I wouldn't say nobody, because a small minority did. That small group of people made incredible amounts of money in the run up that we've had in the next, 12, 13 years. Similarly in COVID, once lending reopened during COVID, the people that knew that it was short term. It was hard to see at that point, right? A lot of us thought COVID was going to last forever.
Yeah.
Right? And it's still out there, but it hasn't shut down the economy again. We thought it was going to be forever. It's hard for us to see in that time that all things move in cycles and all things eventually end. And one day through is another day closer to the other side, So I say all that because I love that concept of it's not if you should be investing in real estate. It always makes sense to diversify. It always makes sense to buy hard assets that don't, evaporate overnight or lose 20% of their value overnight.
Yes.
But it's how, right? It's how, and it's understanding what moves the needle, and it's being able to adjust and being able to find the right strategy. So I think that's just a fantastic message for folks.
Totally agree. And, just to give you one more example. So we actually bought a condo. This is back in 2007. This is just before the crash. So the peak of the market, we buy a condo, and this was to live in at the time in Chicago. And, we moved out and we moved to Philly, and we rented that apartment out. And then the crash hits, and our value goes from $40,000 to like $80,000 in a matter of like a year. But guess what? That property was rented out. It was cash flowing every month, $250 a month, and we held on to it. We held on to it for 10 years. And despite the property value going down by 40%, when we sold it in 2021, over the period of 10 years, we made $100,000 through appreciation, debt pay down, cash flow from that property, and it despite the correction. And so it goes to show again what you were just saying, Ken, like cash flow gets you through the tough times, and once you hold on to it for long enough, you're only going to win.
Yeah, that's right. And I think that's why real estate can do so well, in those downturns, because you don't have to realize, you don't have to sell it during that time. You maintain the cash flow and you continue. And over the long term, we know, because of all the historical data, that it does well. So
That's right.
So love that. Yeah, I think that's a great example too. Great example to really zoom in. So, okay, so we've gotten this point. You guys are still buying. You guys are bullish. You're figuring out how. You're smart investors. But when I talk to the majority of folks, the majority of folks right now seem to really be on the sideline, seem to be just uncertain about what the future holds, and really hitting the pause button, and maybe it's just sitting in a savings account, right? Because right now you can make 5% and that feels good in the near term, even though you have to pay taxes and things on it. There's all those complications. But tell me about, as you talk to a lot of investors, as people reach out to you, what do you think that disconnect is? Somebody like yourself who's growing their portfolio and continuing to move forward and long-term focused, versus most folks right now who maybe aren't as educated.
Yeah, no, it's a great point. And I think part of it has to do with there's just so much negativity in social media and in media in general, where there's all these doomsday scenarios, right? Oh, what if everything comes crashing down? And the truth is that nobody has a crystal ball. Right. No, like economists are wrong all the time. And by the way, like the latest reports that I'm reading now, so Goldman Sachs just came up with a report, and they're now siding with the Fed and saying they don't see a recession happening in 2024 because of one big factor, which is disposable income. And disposable income of American households is still up 4% year over year. And even this year into next year, they're saying it's going to be increase another 3%. And that's a big factor. And with unemployment being so low and all these different factors, right? And so to me, there's one thing that you want to stay on top of. All right, fine, what's happening with the market and all that. But that all to me is noise beyond a point, because nobody really knows what's going to happen. And to me, I want to focus on growing my skills, because investment is risky, not necessarily because the market cycles. Investment can be risky if you don't know what you're doing, right? And so if you're working on your skills and constantly growing them, then it becomes calculated risks. And I would take calculated risks all day long, because that's the only way I know how to scale a portfolio. So when I first started investing 2014, 2015, what I learned the most was from books and podcasts that were giving me a solution of how to invest in any given market, rather than people saying, oh, just don't invest, that's the solution, right? That is never the solution. So in my mind, like if you truly want to grow and scale your business or your real estate portfolio, whatever it is, just focus on growing your skills and being able to buy and invest in any market. And I think that is key, rather than just focusing on, oh, maybe I should wait six months. And at what point do you stop listening to naysayers, right? Is it, there's always going to be 10% of the people that say don't invest. Are you going to keep listening to them? So
that's right. Well, and I love the point that you made about you've got to take calculated risks, right? And whether you are going to do it yourself and build your own skills, or you're going to take a different path and passively invest and invest with professionals that have those skills, I think the important thing to understand is every investment comes with risk. It's always a risk reward, right? Yep. And so I think it's educating yourself to understand what the risks are, being able to accurately weigh that versus the reward, But also, I think oftentimes people, and just our psychology, how it works is things that are unfamiliar are seen as risky,
Yes.
right? And so, and most people know like an uncle or a neighbor or a friend or somebody who like had a bad real estate experience because they got
Mm-hmm.
into something, they didn't know what they were doing, right? And
Yeah.
they thought they could be a landlord, it didn't work out, right? But there's different ways to do it, right? And so I think it's important to understand. So if real estate, just because it's unfamiliar, is kind of viewed as overly risky versus the actual risk, I think on the opposite end of that, I think mutual funds and stocks and 401ks, because it's just so familiar, I often think that the risk there is underweighed, right?
Yes.
The risk of I mean, we're in one of the most volatile markets we've been in a long time, and volatility just degrades returns.
Yes.
Because as you go down, you have to double your returns to get back up, right? And I think that is something that's just undervalued in people's mind, or underweighted as they compare where to allocate their funds. I think my global view is you should always be diversifying. And unfortunately, a lot of the financial advisors tell you you're diversified if you're diversified. You're in stocks and bonds, or you're in large cap
Right.
and small cap, right?
Yeah.
That's not real diversification. Real
True.
diversification includes alternative investments. It includes real estate. It can include commodities, other things to build a true portfolio. If you look at some of the asset allocations of some of the richest people in the world, they are consistently 25 to 40% real estate and other types of assets,
Yeah.
typically. And if you include commodities and things, they're over 50% in that value. So, I just often think of the question, if it works for them, shouldn't it work for everybody? And the answer is yes, right? It's really about familiarity and access. And I think, like you said, educating yourself.
Yes, absolutely. And to your point, it's about, to me, like about how much control you have over your investment, right? If I'm investing in the stock market, anything can happen. I don't run the company. I don't have any influence on the decisions that they take. But if it's my own real estate investment, or if you're a passive investor working with an experienced investor, they have a lot more control over the asset. And when you have control, and if you know what you're doing, you can manage risks a lot better because now you're the decision maker and you've had experiences that you can take the right decisions for the company. So it's also about, for me, like, stock market is great, but it's just, for me, it's like, all right, I can still put it in an index fund maybe, but it's just, I don't have any control over that.
Yeah. I mean, you bring up a really good point with control. I mean, and it is interesting to think about as we talk about risk, right? Because you think about any stock you would purchase, you have very little information on how it's going to perform in the future, and you have zero control on how it's going to perform in the future. And so, I mean, that is fairly risky versus, as you make a real estate investment, as long as you're educated or working with educated people, the level of information is actually much higher, and and you're so much closer to the transaction and understanding,
Yes.
the market, where it is, the property, what are the nuances, what are the business plan, what's actually going to
Yes.
happen. It really is interesting when you think about that level of control and rating risk. I think it's a good point you bring up.
Yep. Absolutely.
So as we think about where we're at, we're in 2023. We talk a little bit about, okay, if there's this uncertainty, which breeds fear, how do people start to overcome that? I mean, how do people get to a point where they feel comfortable that they've got the clarity to make the right investment choice?
Yes, that's great. So we actually have a framework for this, and we talk about this in our book, but it's called the ABLE framework. And whether you are investing, passively, or if you're creating your own portfolio, it can still apply. And it's called the ABLE framework. And so it stands for, I'm going to go through the acronym. So first thing is, A in the ABLE framework stands for figuring out what your avatar is, or what your investment type is, right? So I always say, be very clear about what you're investing in, because and select what it is and understand it really, really well. Because if you're trying to understand like 5 different strategies in real estate, you're not going to get anywhere. Like, focus on one and understand it really, really well. So identifying what your avatar is. And I would go even deeper. If you are an active investor yourself, figuring out where you're investing and why, what kind of property type you're investing in. Because if you walk into Baskin Robbins and say, I want ice cream, they're gonna be like, okay, like what kind of ice cream, right?
Mhm.
And so it's the same with real estate. You need to know what you want to be able, if you don't know what you're getting into, you'll just buy anything then. And that's probably not a good investment. So knowing what your property avatar is or your strategy avatar is. Second is putting the blinders on, right? Not getting distracted, because there's so many shiny objects in real estate or anything in life that you're just gonna, and there's this Greek mythology character that has been basically cursed to push a rock up a hill until eternity. If he pushes it all the way up, and then he has to start all over again from the bottom. And sometimes that's what we do by following different investment strategies. We'll do all the hard work in understanding it,
Mhm.
and then we'll be like, yeah, this seems really hard, let me try this other one here that seems more exciting. And then we have to start all the way from the bottom again to understand that, and we never really achieve what we want to achieve. So putting the blinders on and not getting distracted is super important. And then managing your expectations, right? Because and actually before that, even taking that leap of faith. And I think this is what most investors don't do, or most people who are looking to invest and sitting on the sidelines, to your point. That is the worst thing that people can do. At some point, no matter how much knowledge you have and no matter how much information you have, you still have to take the leap of faith, because at the end of the day, every investment carries some risk with it, right? So if you're always so risk averse, then it's likely that you're just not going to be a part of that, and never going to take action, and never going to build that wealth that you want to build. So taking that leap of faith is super important. And then finally, just managing your expectations once you do, because I always joke that if you go to a gym, if you're like, I want a six pack, and you go to a gym for like a week and you look in the mirror, it's like, nothing's happening, this doesn't work. Yes, but did you do it long enough? Right? It takes a while for the results to show. And so be impatient when you're putting in the work, but be patient to see the results, because that takes time.
Mhm.
And so just managing those expectations, and there will be a couple of failures along the way, right? You will fail, and you need to, and that's great, because that's a way to learn
Mhm.
and keep moving forward. So that's kind of the able framework that hopefully helps to take action, not get stuck in analysis paralysis, not sit on the sidelines.
Yeah, I love that framework. So the avatar, understanding what your strategy is. Like, do you want to be active? Do you want to be passive? Right at
Yes.
the beginning, and then which type of asset do you think is the best, right, or the most appropriate for you and your risk profile, your time horizon? It might be triple net leases, right? If
Right.
very low risk, lower return, all the way to buying distressed properties where you've got to, completely rehab them, which is, very high risk, but could be very high return, right? And there's a whole
Yes.
gamut of things in the middle. So understanding your risk profile and where you sit. I love the idea of the blinders. And I think, many of us, I'll admit myself included, as I got started, absolutely had that shiny object syndrome, because
All
I
of us
mean,
do.
it's so easy, right? You're, oh, this
Yes.
could be cool. This could be cool. This could work. But I agree, and just putting the focus on and really niching down and becoming an expert in one thing. Once you're an expert in one thing, then you can start to move into other areas, because you'll see tangents and kind of familiarity and similarities, but really getting good in one place. Like mine area of focus was multifamily,
Right.
and particularly larger multifamily. I mean, yours is different, like single family, quads, like different strategies, both effective. We just picked one and got really good at that one, right?
Right.
And then the hardest is the leap.
Yes.
I mean, I think, most people can get through, okay, avatar, that's just homework.
Yeah.
Blinders, okay, I can stay focused. That's more homework. Leap, it's moving past analysis to action. That is
Yes.
such a hard hurdle to overcome. I think that's where most people get stuck. And I think that there's ways to step into that. Like for me, the way I really stepped into that was I started passively investing with other people to learn from them before I started actively investing on my own. I mean,
Sure.
there was about 5 years where I was investing with others and kind of ramping up and starting to do some small projects on my own before I really went full active and started
Yes.
buying big properties. And for me, that was just a great learning experience in a lot of different ways. And so that's one way to do it. But I think it's figuring out how to get yourself to take that leap, and then managing expectations, I think is great, because like you said, I mean, for you, it took you, I think you said 2 to 3 years before you really had the thing rolling, and you're seeing the snowball really start to build. It takes time. It doesn't happen overnight. And so I think making sure that you don't get discouraged, manage your expectations, but get started, because it takes years. I mean, if you want to if your goal is to leave your W-2, and replace it with real estate, that's probably a 5-year plan.
Yes.
Right? I mean, it takes time. Maybe you can do it faster than that. But if every year you lay it off and don't do it, you're kicking the can down the road, let's say 5 years. And time is the one thing that none of us can get more of. And so I think the message here, hopefully exciting you guys, is figure out how to take that step forward. Even if it's a baby step, you don't have to leap right away, but at least take that baby step, move forward, take action, and invest in something, right? I mean, get off the sidelines, because you can read all the books, and I was guilty of this, right? I'm an analyzer for sure, books and podcasts, all that. But at the end of the day, the only way you really learn is by getting into it.
That's right. And, it took us, for our first BRRRR project, it took us a full year to do that project. 1 year to do one single family home. And we're like, wow, this takes long. And then after that, it was so much faster.
Yeah.
But that's because we didn't give up, and we're like, oh, you know what? It took us longer because we did this, this, and this. What if we improve this for the next project? What if we made these tweaks? And that you can only do once you've taken that leap of faith, once you've started taking action. And that's when you learn the most, as you said.
Yeah, absolutely. Absolutely. There's some probably overly used adage, but it just made me think of this. It's like, people ask you, when's the best time to invest in real estate? And you say, well, I don't know, pick your year, two years ago.
Yeah.
Right? And what's the second best time? Right now.
Yes.
And so, I think that applies here. I think that's the message. And I love what you said, just bringing it back to another thought as we start to close things out, is the idea of, when you think about social media and just headlines and all this, I mean, it's just a cesspool of negativity. That's what grabs attention, right? That's what grabs eyeballs. And the blinders are so important to understand it, but don't get wrapped up in it, and don't, I love the advice that don't take advice from somebody that you don't want to be, right?
That's right.
So internet trolls are not who we want to be, right?
Yeah.
Think about where the advice is coming from, and is that somebody whose life you'd like to have and do what they do, right? Those are the people we should be listening to. So find good sources of information. They are out there, and it all is not negative. It all is not doom and gloom at the end of the day. And as Nidhi said, it's not when or if. The answer to those is yes. It's how you do it, right?
Yeah.
There's a lot of different ways. So love it. I feel energized. I'm going to go invest. Nidhi, before I let you go, man, I want to take you through our keys to success round. 4 questions I want to ask you. The first one is, if you were going to invest your money with someone else and you can only ask them one question, what would that one question be?
It's a good one. I think one would be, the biggest one that I can think of is, I think history is a great predictor of success. So I would ask them, show me your track record, right? Like, well, how many deals have you invested in? What's your success rate been? And that will hopefully tell me a lot about how they handle, if somebody's like, oh, I'm just done like one deal, like, yeah, I don't know if I want to invest you, because you haven't seen enough deal cycles, you haven't seen enough market cycles. And so I think that would be a big question.
Yeah. And similar to that, I mean, I think track record is outstanding. Similar to that, I love to just hear about a project that didn't go so well. And
that's a good one
with it, because I think that's the thing that people have to understand about real estate is, I mean, it's all about solving problems. There are going to be things that come up. It's how you plan for it on the front end, and then it's how you execute as you go through it, and how resilient and versatile you can be, and how creative you can be. Right. And so I think
Absolutely.
if somebody tells me, oh, we've never had any problems, and it's like, well, you just haven't been doing it long
Yeah.
enough. And I can
Right.
tell you that's the
Exactly.
truth. You could, I mean, you can verify that too. But it's
Yes.
how did you work through it? Who did you bring in? How creative were you? You know, how did you get past it? What was the outcome? I just love to hear those stories, because I mean, you're really doubling down on that person at the end of the day, right?
Absolutely.
Are they
Absolutely.
going to be somebody that's going to see it through to the end and get it
Yes.
done? Yeah. Oh, great answer. What are you most proud of in your career?
Uh, so I would say, when I was growing up, society always tells you what you can't do, right? That's how we're all great. We're all risk takers as infants and as kids. But then as you start growing up, society puts you in a box and tells you what you can't do.
Yeah.
And for me, that was, you're not an entrepreneur. You don't know how to do business. You've never been a business family. You just need to get a job. And to me, the day that I proved that wrong was huge, because that just tells me that any limiting beliefs that you have about yourself or anything that society tells you, you can work on it and you can totally get over that. And that to me was a big one.
Absolutely. The only limitations are ones you put on yourself, right? So
Yes.
love that. Love that. What book should everybody read?
That's a good one. I would say, if there's one book that helped me the most, when I was first sort of starting out, was a book called The One Thing. And it's basically about how we're always taught to, do everything, right? You need to be good at like everything. Oh, better not, like, if you have like 100 things to do, make sure every single one of them gets accomplished with the same level of perfection or whatever. And the book talks about how 20% of the things that you do gives you 80% of the results in your life, right? And that's the Pareto principle. But the book goes a lot deeper into how you can implement that in your life and your business. And I just love the idea of, if I can focus on only 20% of the things in my life, what would those be? How do I prioritize those in a way that gives me the 80% of the results that I'm looking for? And sometimes it's even more. Sometimes 10% of the things are going to give you 90% of the results. And if you can make that a part of every decision in your life and prioritization in your life, not just in business but in your personal life, I think that'll be amazing.
Absolutely. Yeah. That's a fantastic book and a really strong message.
Yeah, yeah, I reread it from time to
Yeah. I
time.
mean, it's one of those you can read every year or so,
Yeah.
and take some gems away. Absolutely. So, Nitty, last question. What is your number one key to success?
I think for me, it's, you can achieve anything in life, just knowing your why is a great starting point. Because all of us want to do so many things, and like, oh, I want to start a business, or I want to do investments, and I want to retire early. And I've been wanting to do that since I was in college, but none of that actually mattered until I had my kids. And then my kids became my why of why I wanted to achieve those things, so I can spend time with them or give them generational, pass on some wealth to them, right? And more importantly, now pass on knowledge and skills to them. So if you know your why, you can get through anything. And just remind yourself of that every day. If you're building a business, if you're starting investing, or anything tough that you're doing in life, just knowing your why will help you get through the tough times when you're not seeing the results and you have failures. So I would say that to me was knowing my why and finding it and acknowledging it. Just that was it. That was the drive that I needed to achieve anything.
Absolutely. And I think that's so well said. Just going back to your why. And there's another great book, Simon Sinek's book. It starts with why, and that really
Yes.
is good at helping people get clear on that message. And he's got some good stuff on YouTube as well around getting to your why. But yeah, I think super powerful. I think that's what pushes you through when times get really hard. So love that message. Love that message. Maybe it's the why that helps people take that leap at the end of the
That's
day.
right.
Getting really
That's
clear on that why, right?
spot on.
Yeah, love it. Well, Nitty, thank you so much for coming on the show today, inspiring us to go out and invest. if people want to get a hold of you and learn more about what you're doing or your new book, Accelerate Your Real Estate, how can they get a hold of you?
Oh, thank you, Ken, for having me. This is such a pleasure. So yeah, if you want a copy of my book, you can go to it's on Amazon. It's called Accelerate Your Real Estate, or you can follow me on Instagram. It's RE Wealth Blueprint, RE Wealth Blueprint on Instagram.
Awesome. Well, we'll link all that in the show notes below. So folks, click on it, get access. And with that, Nidhi, thank you so much for coming on. And I hope you have a great rest of the day.
Thank you, Kent.
Thanks for listening to another great episode of Ritter on Real Estate. Hit the subscribe button to make sure you don't miss out on the content that will make you a better investor. Also, visit KentRitter.com for articles, videos, and tools curated just for passive investors. Until next time, this is Kent Ritter with Ritter on Real Estate. Now go out and invest like a pro.